So taking a look at the question here, it says the financial position of Miller Limited, a grocer, on the 1st of the 1st, 2018 is shown in the following balance sheet. So you have your balance sheet there on the left hand side with all your assets and liabilities. And then you are told the following transactions took place during 2018. So in January, Miller Limited decided to revalue the land and buildings on the 1st of the 1st, 2018 at €800,000. The land element of this new value is €130,000. Now at this point in time, I would like for you to underline the land element of this new value is €130,000 and draw a line down from that to December. So December's workings, it's asking you to do depreciation, so it'll be important that you remember that there's land included in the cost there for land and buildings, so we need to take the land away when we are depreciating the buildings. Okay, so February says Miller Limited bought an adjoining business on the 1st of the 2nd, 2018, which included buildings €120,000, delivery vans €35,000, debtors €15,300, and creditors €11,000. The purchase price was discharged by granting the seller 140,000 shares in Miller Limited at a premium of 30 cents per share. March, management decided that the provision for bad debts should be reduced to 4% of debtors at the end of March. May, received a bank statement at the end of May 2018 showing a direct debit of $4,800 to cover insurance for the year ended 30th of the 4th, 2019, and a credit transfer received of $8,800 to cover rent received in advance for the period May the 1st, 2018 to March 31st, 2019. In September, a dividend of 5 cents per share was paid on all issued shares. In November, a payment of €840 was received from P. Ryan, a debtor whose debt had been previously written off and who now wishes to trade with Miller Limited again. This represents 70% of the original debt, and the debtor has undertaken to pay the remainder of the debt in February 2019. On the same day, goods to the value of €780 were sold on credit to Ryan. This is a markup on cost of 20%. In December, the depreciation charge on buildings for the year is to be 2% of book value. The depreciation charge is to be calculated from date of revaluation or date of purchase as appropriate. The total depreciation charge on delivery vans for the year was €21,000. So what is required? So record on a tabular statement the effect each of the above transactions had on the relevant asset and liability and ascertain the total assets and liabilities on the 31st of the 12th, 2018, and that is 60 marks. So you've got 27 minutes to do this question. So that's what the completed one is going to look like. And you'll be given in the exam paper, which is gridded like this for the use for tabular statements. So step one is to lay out the tabular statement. So what you're going to do is you're going to list all of the assets up here and you're going to list all of the liabilities down here. So here's your list of assets and here's your list of liabilities. You're going to put in the amounts into the first column here, the 1st of the 1st, 2018. So you've got your 660,000 and then you take away your depreciation, 33,000. Then your vehicles, you've got your 85,000 and you take away your depreciation, 38,000. Then you've got your stock, 57,120, and then you have your debtors, 82,400. Now you can see that that's different from here, but this figure here, 78,280, is 95% of debtors. So we want to put 100% of debtors here and then take away whatever the 5% is. So the 5% is bad debt provision, so 4120 is to be taken away there. Then we have share capital, 450,000, and our share premium, 59,000. We have our profit and loss, 205,400. Then we have our creditors, 64,000, our bank, 24,000, and our expenses, 7,000. Now, it doesn't matter what order you put all of those things in at all. You can put them in any order that you want. Now, you'll see here that I have a couple of items in red in both of them. Okay, so you will have to enter things as we go along. right? So just leave a couple of lines free and then you'll be writing these in later on as you require them. Okay, so getting started then, recording the transactions. January, Miller Limited decided to revalue land and buildings on the 1st of the 1st, 2018 at €800,000. The land element of the new value is €130,000. Now, I've already asked you to underline that last sentence, the land element of the new value is 130, and draw a line down to December for when you're doing your depreciation. Now, so land and buildings then, 660 plus 140 is 800,000. So I'm going to add the difference between the old cost and what the new value is into the cost. Then I am going to unwind any depreciation that has previously been taken away from the value of the building. So that is 33,000 there. When I add them up, it's 173,000. So I know that's what happens in the top of my balance sheet. What happens below, I create a revaluation reserve and I put in the 173,000 there. So I've got 173 and 173. So that's January done. February, Miller Limited bought an adjoining business on the 1st of the 2nd, 2018, which included buildings €120,000, delivery vans €35,000, debtors €15,300 and creditors €11,000. The purchase price was discharged by granting the seller 140,000 shares in Miller Limited at a premium of 30 cents per share. So this is what it's going to look like. So we included buildings 120,000 here. We had delivery vans 35,000. We have debtors 15,300. Then we move down, we have creditors 11,000. So creditors down in the liabilities 11,000. The purchase price was discharged by granting the seller 140 shares in Miller Limited. Now you look back at your balance sheet and you see that each share is €1 each. So that is 140,000 there at a premium of 30 cents per share. So 140,000 multiplied by 0.3 or by 30%, we get 42,000 that is going to go into share premium. So it's just a charge whenever you are selling shares. So 42,000 is going to go in there. Now, at this point in time, our assets and our liabilities don't equal. Our liabilities are more than our assets. So our liabilities are €193,000. Whereas my liabilities aren't. So I have to find the difference. The difference is 22,700, and so I put that in as goodwill. So goodwill is when we purchase a business and the business that we buy has an established reputation that you are technically paying for. Okay, so a well-known, well-regarded, high-regarded business. Okay, so 22,700 total assets, total liabilities now equal. Then moving on to March, management decided that the provision for bad debts should be reduced to 4% of debtors at the end of the month. So what we do here is we look and see what are our debtors at, where are they currently at, right? So we don't just look at the figure that we had at the start of the year. We have to remember in February we bought a new business which included debtors. So my new debtors figure is 82,400 and my 15,300, so that is 97,700. Multiply that by 4%. My bad debts provision should now be 3,908. Now, you see here at the start of the year, it was minus 4,120. So we are going to reduce that. So we want to add 212 back in there to make it 3,908. So that is, at the moment then, our bad debts provision is standing at 3,908. Now, a reduction in bad debts provision is going to increase my profit figure. So I'm going to put the 212 into the P&L. So you would know in your question 1 that you put a reduction in bad debts provision into add operating income. So that is going to increase our profit. So we throw that in there, and 212 in assets, 212 in liabilities. So that's March. May. So in May, received a bank statement at the end of May 2018 showing a direct debit of 4,800 to cover insurance for the year ended 30th of the 4th, 2019, and a credit transfer received of 8,800 to cover rent received in advance for the period May the 1st, 2018 to March 31st, 2019. Okay, so what we're going to do in the May column first of all is we're just going to enter the full amounts into the bank and then figure out where the other figures need to go. So let's just think about the bank first of all. So in the bank, we're going to add the money that has been taken out of the bank, which has increased the bank overdraft. So here you'll see that a direct debit came out of the bank, 4,800 to cover insurance. So that insurance is going to increase my bank overdraft. This is the bank overdraft, it's in liabilities. Whereas we received 8,800 rent received, so that is going to decrease my bank overdraft. So I'm going to minus that 8,800 there in the bank. Now, what I'm going to do is I'm going to suss out where else do I put these items. So if I have here a bank statement at the end of May showing a direct debit of 4,800 to cover insurance for the year ended 30th of the 4th, 2019. Now forget about the when we receive the bank statement. A bank statement will have transactions for months on it, okay? So some people get confused about that. May 2018 actually has no relevance here. We're going to look at the dates that it's telling us here. So a bank statement could have transactions that have going months back on it, so don't concern yourself with that. So cover insurance for the year ended 30th of the 4th, 2019. So we are doing this tabular statement for 2018. So 30th of the 4th, 2019 means that we will have insurance prepaid for 4 months of next year. So therefore, I'm going to write in my assets, insurance prepaid 4,800. Okay, and then we're going to suss out, right, what about the rent received? So I have rent received in advance for the period May the 1st, 2018 to March 31st, 2019. So I have rent receivable prepaid then at the end of the year. So it's paid up until March next year. So what is rent receivable prepaid? Well, anything receivable prepaid is a liability. So I'm going to throw my 8,800 into my liabilities there. So that is 4,800 and 4,800. Now, while we are doing the bank statement adjustment, what we're going to do then is go to the second December column. So we'll always do 2 December columns, one for the depreciation and then one that relates to the bank statement adjustment. Now you can do them in the same column, it's absolutely no problem, but if you need to remember that you have to do 2 things in December, the depreciation and then finish the bank statement adjustment. So what we're going to do in this December column is we're going to say, well, how much of this relates to the current year, which is 2018. So how much of this insurance relates to 2018? Now, there was no insurance prepaid at the start of the year. 4,800 was for 12 months, but we have 4 months prepaid for next year. Okay, so 4,800 multiplied by 8 over 12 is what relates to this year, so 8 months. So that is 3,200 there. So whatever I have here, I'm going to change the signs there, so I'll take away 3,200, which leaves me with 4 months prepaid at the end of the year, which is 4,800 multiplied by 4 over 12. Now, what does insurance paid for the year do to my P&L balance? Well, my profit is going to reduce because I am going to have paid an expense. So I minus 3,200 from the P&L. Now, the rent receivable. How much of this 8,800 relates to the current year, 2018? Well, I look here, I go back over here, a credit transfer received of 8,800 to cover rent received in advance for the period May the 1st, 2018 to March 31st, 2019. So 3 of the months are for next year. Okay, 3 of the months are for next year, but how many months are for this year? So we've got May, so it says May the 1st here, so we've got May, June, July, August, September, October, November, December. So that is 8 months for this year and 3 months for next year. So 8,800 multiplied by 8 over 11 is 6,400, and again I just changed the sign from whatever I have here. Okay, so 6,400 minus here, and then that means I have 2,400 prepaid, rent receivable prepaid at the end of the year in my current liabilities. Now, if you're unsure about what signs to have here. If they're both in the current liability, we want to change the signs. Okay, so you'll get used to doing that. So 2,400 rent receivable prepaid. Okay, so that's very important that you learn how to do that, because there's an awful lot of work going for, or sorry, an awful lot of marks going for the month where we have our bank statement received, and then adjusting it in our December column as well. Okay, so now we have September. So a dividend of 5 cents per share was paid on all issued shares. So I have had some additional shares during the year. Okay, I have issued some more. So 450 plus 140. So we've got 590 multiplied by 5 cents per share, and that is 29,500. Now, 29,500 is going to come out of the bank. So we are going to pay the dividends out of the bank. This is a bank overdraft, so we are going to add the 29,500 there. Now, what is that going to do to my P&L balance? It is going to reduce my P&L balance, so minus 29,500 here. So that is September done, nice and quick one there. Now, November is a big one. So a payment of €840 was received from P. Ryan, a debtor whose debt had been previously written off and who now wishes to trade with Miller Limited again. This represents 70% of the original debt, and the debtor has undertaken to pay the remainder of the debt in February 2019. On the same day, goods to the value of €780 were sold on credit to Ryan. This is a markup on cost of 20%. Okay, so we received some money from a debtor whose debt had previously been written off as bad, and they've promised to pay us the remainder again. So that is going to be bad debts recovered. Where do we put bad debts recovered in question 1? Well, we put them in add operating income. That is money that is going to increase my profit figure. So if we think about that first paragraph there, what do we have? Well, we're going to add the amount the debtor has promised to pay us back. So that's our 840, which is here, and that is 70%. But they're promising that they're going to pay us the other 30%. So that is 360 that we are adding to the debtor there. Now, the amount that we have received into the bank, the 840, that is going to reduce the bank overdraft here. And the total amount, the 360 and the 840, which is 100% overall, is 1,200, which is going to be bad debt recovered, which is going to go into the P&L account. So that is the first paragraph there. Next, we have, on the same day, goods to the value of €780 were sold on credit to Ryan. This was a markup on cost of 20%. Okay, so that's the second thing that happened there. So goods to the value of 780 were sold to Ryan. So 780 is going to be added to Ryan's account, to the debtor account. Okay, then what we have to do is we have to take the amount of stock, so the cost price of the stock, away from stock here. So how do I find that out? Well, 780 is markup on cost of 20%. So if we just find out what 100% is, that is going to tell us how much the stock was. So 780 divided by 120 multiplied by 100 is 650. So 650 taken away from stock there. Now, what is the 20%? Well, the 20% is the profit. Okay, so the difference between the 650 and the 780 is €130 there. So we can calculate it by going 780 divided by 120 multiplied by 20, which is the markup, and that is €130. So €130 is going to go into the P&L account. And that is November complete. Last month we have is December. So the depreciation charge on buildings for the year is to be 2% of book value. The depreciation charge is to be calculated from the date of revaluation or the date of purchase as appropriate. The total depreciation charge on delivery vans for the year was €21,000. Okay, so remember in January I asked you to underline that the value of land at that point in time was whatever it was 130,000. So we have to remember now, decrease the value of asset buildings by 15,600. This is the depreciation that we've worked it out to be. How did we get 15,600? Well, the land was revalued to 800,000, do you remember, in January? But that included land of 130. So 800,000 minus land 130, multiply by 2%, and they had that for the whole year, so that is 13,400. Then in February, they bought buildings, they bought new business, but there was buildings included in that. So 120 by 2% by 11 over 12 months, because that was bought in February, and that is 2,200. So 13,400 and 2,002 is 15,600. So the land and buildings, the depreciation there on them, 15,600, and that's only on the buildings. What's that going to do to my P&L? Well, I'll minus 15,600 from here as well. Now that's incorporated, the two figures are here, but we can put them in separately either. So minus 15,600 here also. And then it just tells us the total depreciation charge on delivery vans for the year was 21,000. So from my vehicles, I minus 21,000, and then another 21,000 is going to go in here. So you can put them in separately or together. So either way is fine, but maybe putting them in separately is safer in case you get one of the figures wrong. Okay, so that is all of your months done. All you have left to do is tot up all of your totals. So you can see there were 7 marks going for that there. You can pause the video if you want to take them down or just tot them up there yourselves. So that is the 2000